Wall Street backtracking from some of its earlier gains Friday afternoon after initially bouncing back rather firmly from the steep two-day sell-off. S&P 500, however, still below its 200-day moving average. Let's get a better sense of the markets. We're joined by Rich Guerrini. He is CEO of PNC Investments and joins us via Skype from Pittsburgh, Pennsylvania. Happy Friday, or TGIF, I guess, Rich.
Thanks, Fred.
The way the markets are behaving today. So how would you describe the market action that we're seeing?
Well, I think we're kind of in a deja vu moment. It seems awful similar to what we experienced back in February, where we were at a place within the markets that we hadn't seen any volatility for quite a period of time, and it returned on concerns of wage increases, inflationary pressures, and we got a little bit of a calm throughout the summer. And here we are 7 months plus later, and we're kind of seeing the return of some violent volatility as we've seen the last 2 days, with the market shedding off about 1,300 points. What I find interesting to your opening comments, Fred, would be what I was concerned with. We saw some stability this morning with the market bouncing back a bit, but like the pattern of the past couple of days, as we get late in the session, we're starting to see a bit of a give back of some of the earlier gains, and I'll be curious to watch what happens between now and 4 o'clock and the close of the markets.
Especially with perhaps investors not wanting to hold positions over the weekend, possibly?
Absolutely. I think we saw that pattern really come to life when we saw the volatility earlier in the spring. We would see a good day midday, and then we saw investors not wanting to hold stocks overnight. And being that it is a Friday, and a fluid news cycle. We live in a world now that news happens 24/7. I'm sure there's a lot of investors out there and institutional investors that probably are concerned about what they hold overnight, let alone over a weekend.
Rich, do you feel that every time we have market plunges, the question comes up: have we seen real capitulation? And if so, do we need to see real capitulation before the markets go higher, or has it fallen enough?
Well, we've seen a pretty good run. We look back at the last episode in the spring, right? We saw the markets come back, testing the highs. And even right now, with the downturn that we've had the past couple of days, we're still within, plus or minus 5% of all-time highs. It's normal, it's common, and it's healthy, frankly, for markets to correct. And as I look at the episode that we're in right now, it is a correction, right? There are folks taking some gains off the table, but I think what's important is that we look at the economy and we look at economic factors, and that still continues to be a pretty good story for the United States. Low unemployment, where inflation, although rising a bit, not out of control, and we have a Fed that is, closely watching, and I think has their hand on the trigger to make sure that if we see increasing levels of inflation, that they're going to react accordingly.
Is there a level of exhausted selling that you think you need a further drop of, say, X% for stocks to have a good rally?
I'm not sure that. I would say probably we might see another 5%. I'm not really sure. I was encouraged this morning when I did see the futures and the opening where the market did rebound a bit. But I do believe we are going to be in a scenario for the next week or two that we're going to see patterns similar to today, where we're going to see the market go up in the morning, and we're going to see it probably sell off and give back some of the gains until we get some better footing. And then I think we still have the chance in 2018 to be at a place that we have decent returns for the year. And I think that'll carry over into 2019. But, we have to come to the realization that we are at the end of a long economic growth cycle. When is the end? Who knows, right? It's all of our guess at this point, but we know it's been a long one. We know it's been a good one, but indications and economic factors still show us that we have some legs left to get some returns for our investors.
And with the markets at these levels, Rich, what are you telling your clients? Of course, I'm sure it's not to panic, but is it okay to start nibbling? And if so, nibbling in what sort of sectors?
Yeah, we are talking to our customers at PNC and PNC Investments. First of all, to your point, yeah, don't panic. This is not a time, like we said in February, for a knee-jerk type of reaction. I think there's a lot of carnage out there right now. The interesting thing about this correction, there really wasn't any sector for the most part that was spared by it. I think it's important for our investors and your viewers to really go back, visit their goals, visit their time horizons, and make sure that they are embracing diversification. I think that as I look at some of the sectors, I look at tech that has really been battered. I'm not sure that this is a level that you necessarily want to jump back in at. But at PNC, we don't talk to our investors about sectors so much versus asset allocation, and really making sure that we're participating in all the appropriate sectors, including technology. But we need to make sure that I think if you're going to take larger positions, that you're doing it in a prudent fashion and really understanding what does the future story hold for a given organization.
All right, Rich, we'll have to leave it there, but thanks a lot for joining us with your thoughts on this Friday.
My pleasure, Fred. Good to see you.
Good seeing you too. Our thanks to Rich Guerrini of PNC Investments joining us via Skype from Pittsburgh. I'm Fred Katayama. This is Reuters. Have a great weekend.